What's up, everybody? Shawn King here with Legacy Life and Retirement, and today I'm going to go over a quick comparison between two products that you've probably heard a lot about lately, and I'm going to try and make this as quick as possible. So if you would like some more information, please feel free visit our website at legacylifeandretirement.com. Reach out to me on all of our social media platforms, and I'll be able to better explain maybe which one of these might be the right fit for you. So we have the IUL and the participating whole life policy. Very similar in a lot of ways, but very different in some very important ways as well. So we'll just do a little side-by-side comparison here. The IUL, builds cash tax deferred. People get this confused a lot. They think, oh, it's tax-free. No, the loans that are withdrawn from the policy are tax-free. Loans are not taxed in this country. The way it grows is tax deferred. Same thing for the participating whole life. Tax-free death benefit. That means all the money that builds in the policy, as well as the death benefit that you start out with, whether it's increasing or not, it's going to be paid out tax-free to your beneficiaries. Same thing with the participating whole life. Money is liquid. Money is liquid in the participating whole life as well. Be careful with the IUL. With the participating whole life, you have the ability to take up to close to 90, maybe even more than 90% of the cash value in the policy. You could do something very similar with the IUL, but you want to be careful again because you could end up imploding your policy on some bad interest crediting years, and we'll talk about that in a second. Living benefits, both policies have those. Money mirrors market indexes. So with an IUL, your money is actually tied to market indexes. The most common is the S&P 500. Now, don't get this confused. Your money is not in the market, so you can't suffer losses from the market, which means when the market takes a dip, your policy will not drop below the 0% line. Most of them have a 0.25% guarantee, but your money mirrors the market, which is sometimes how it gets some of these potential better growth. As far as participating whole life, has nothing to do with the market, zero to do with the market. Your money is not tied to the market at all. Cost of insurance increases over time. With an IUL, it is a repeating, renewing term, essentially. So the cost of insurance is going to get more expensive over time. Now, the thought with the IUL is because of the growth potential that it has, that cost of insurance will be covered by the growth that is within the policy. But this, again, could be fatal to your policy if things don't go well. Over here, cost of insurance is level. It is never going to increase. Company can change the rules. Essentially, things can change. Your participation rate can change. The cost of insurance later on can change. There's things within an IUL that can change that you want to be aware of. Now, with participating whole life, contract is locked in. The contract is the contract. What it says is exactly what it is. Non-direct loan recognition. Now, both of these have non-direct loan recognition. All that means is when you're taking money out of the policy, when you're loaning money from the policy, which would be from the insurance company, because you never loan your own money. We use OPM, other people's money. When you're loaning money from the policy, that is not recognized as money being outside the policy. So if you had 100 grand and you took 50 grand out, you're still earning interest on 100 grand. Non-direct loan recognition. Continuous compounding interest. Same thing. If you took that money out of your policy, say you had the 100 grand and you took 50 out, well, you're still earning interest off of 100 grand because one, it wasn't recognized as it being out, and two, you have uninterrupted compounding interest. So even if you're taking loans out, they're not recognized, you're earning that continuous compounding interest. No guarantees in the IUL. This is big. This is why you want to be careful with taking money out of your policy, especially early on, because you could have a couple bad years in the index, not get any interest, and you could implode your policy if used improperly. Over here with the participating whole life, you have guarantees. I love guarantees. Now, I have both of these policies, but I love guarantees. Over here, we've also got dividends. There's no dividends listed on the IUL because there's no dividends that are received. With the participating whole life, they say that they are not guaranteed. but we use companies that are well over 100 years old, that have been practicing insurance for well over 100 years and been paying dividends without missing a beat for over 100 years. So I'm not going to say that they're guaranteed, but they do have a nice track record. This is also a very old style of insurance, over 200 years old. IULs are fairly new. Now we've got higher potential returns, higher potential growth. With your IUL, because it's tied to the market index, you do have, my son's going crazy right now, you do have the ability to have higher potential growth compared to the participating whole life, but it really depends on what you're looking for. A little bit more risk over here, no guarantees, higher potential growth, guarantees, dividends over here. I would say I would not suggest this for IBC Infinite Banking, and I think the participating whole life policy is what the infinite banking concept is built off of. That is exactly what we suggest you use it for. Again, my professional opinion, I would not use the IUL for infinite banking. People do, not me. I have both of these products. Oh, last one here, can't lose money. Now, in all reality, you cannot lose any money guaranteed in your whole life policy, in your participating whole life policy. Really, you can't lose in the market in your IUL, but you do have those risk factors that you could be taking money out. The cost of insurance could get too high and it could essentially implode on itself. Now, to be honest, again, I have both of these policies. I use them for different reasons. This one's more structured around retirement. I said it, I forget it, I overfund it, and this is where my money goes, the majority of my money for my daily, monthly, and yearly expenses, because this is how I bank. This is how I take control back from the system using my participating whole life policy. So that's basically it. I don't want to make this run too long, but if you have any questions about either or what one might be the right fit for you, check out my website, legacylifeandretirement.com. Definitely get yourself this book if you're interested in infinite banking, and reach out, schedule an appointment, hit us up. We'd love to help educate you. Hope you guys have a great day.